Good morning, everyone. I'm Caryn Shea, and I'm here to start the presentation on audit process revisions, common audit findings, and accounting findings with PERAC. I will be presenting the first section of it, the audit process revisions. The second portion, the common audit findings, will be presented by Scott Henderson, the Deputy Chief Auditor. And the accounting filings with PERAC will be presented by Cheryl Johnson, who's the Compliance Investment Data Coordinator. So starting on our new audit approach, as many of you may have heard already, we've been discussing different strategies to expedite our audits, while still assuring a quality review that is comprehensive and helpful to retirement boards. So under our new audit approach, why isn't this working? Bear with us for a second. So the goal of our new audit approach is to conduct strategic risk-based audits, which target the high-risk areas, also to avoid duplication of efforts with independent auditors and produce more effective and timely audits. As you know, the independent auditors are auditing all retirement systems on a yearly basis, either a full financial audit or they're being undertaken by, as part of the municipality's audit. So we'd like to obviously avoid the duplication, review their work, try and use some of their work, so you're not getting hit with 2 audits for the same years. Okay. We have a couple of PERAC memos out there, number 20 from 2008, and that one goes over the process for hiring a CPA firm to perform the audits in lieu or in conjunction with the PERAC audits, and memo number 18 of 2019, and that one's entitled Audits, and that was the one that announced our new approach for the audits. What we're looking to do is to perform limited scope audits. This way we target 2 or 3 specific areas that have been found to be deficient in multiple boards. The targeted areas may change from year to year based on our findings from the high-risk vulnerable areas, the PERAC audit findings, the findings in the independent audits, and the input from the other PERAC units. So this is a chart of last fall. We did our first risk assessment of the audits that were coming due, and this was the chart we used. This was a result of the 3 years looking back on the PERAC audits, and these were the deficiencies we found at the numerous board. So we looked at 65 audit reports, and 15 of those had no findings, but in the other 40, there were 117 findings. As you can see, the highest area of findings were regular compensation and member contributions, cash reconciliations, board minutes, board governance, and board member attendance. That was all the same, and then retirement calculations. So in order to determine what level of risk, what level of audit coverage would be needed at each of the boards, we identified these categories of risk. So we identified the independent audit. Well, we were going to look at these areas to determine the level of risk. The independent audits, how they manage the investments, the stability of board and staff changes, prior PERAC audits, annual statement reviews, and input from other PERAC audits. I will get into more detail about these individual categories in later slides. So what we did was we requested specific information from the boards, and these were just the boards that were due to have an upcoming audit. We researched their annual statement reviews of these boards. We reviewed the findings from previous audits, and we requested information from other PERAC units. So this was done for each of the boards that we're going to have an upcoming audit. We'll do this again probably at the end of this year for the next batch, the next cycle of upcoming audits. So what we're looking for when we're looking at the independent audits, you know, did they have an independent audit each year of the audit period? Was it a full financial audit, or was it just part of the municipality's audit? Were there issues, findings? Was a management letter issued? So these are the things where the areas we're looking at, and that will determine our risk based on the answers to these questions about the independent audits. The next category is the management of investments. You know, how is the board managing their investments? You know, do they have multiple managers? Do they have a consultant? Are they partially or totally invested in PRIT? Were there prior finding audits regarding their investment activities? All these things, or somewhere in between. Then we have the stability of the board staff. We're looking at, you know, the length of tenure. Has the administrator been there, you know, 20, 30 years, or have they just started? Same with the staff and the board. Were there key turnovers during the time of our audit period? We're looking, you know, we look at these things because if there are key turnovers, you could have the loss of historical knowledge, or if it's someone brand new that doesn't know Chapter 32, you know, that's risky also. So those are taken into consideration as well. All right. Okay, so our next area that we look at are prior PERAC audit. We look at the results from the last audit, consider the number of findings and the significance of the issues found. That's another area. And then we're also looking at the annual statement reviews. And each year the audit unit reviews each annual statement received. So I went back and researched the annual statements for these particular boards. You know, were there many questions that we needed to go back and ask the board? Was it clean? We didn't have any questions. Were they submitted timely? Were extensions requested, or was there no communication at all? Was the extended deadline met? These are all, again, all areas that we look into to determine the risk. And our last category is the input from other PERAC auditors. So other PERAC units. We reached out to the other units. There's a list of the units: investment, compliance, disability, fraud, legal, actuarial. Because these units interact with the boards on a more regular basis than the audit unit does, we are collecting information on any activities or issues that they've had with the board. Okay, so those are the 6 categories that we looked into, and based on that research, we had to apply a risk level. 5 being the high risk, 1 being the low risk, and a lot of them were somewhere in between there. So each category, I did this for each of the categories, and then all the categories were equally weighted to determine the overall average risk level. Again, this procedure was completed for each of the boards that were to be audited. So once we calculate that overall risk level, we can now calculate or determine the audit level. They were put into, all the audits were put into, boards were put into 3 groups. If it was a risk level of low, there was going to be the audit level will be a limited scope. Medium to low is going to be increased scope, and then the medium to high will be a full audit, which is what you've been getting up until now. Okay, so we had to come up with new audit plans for these new, for the new audit coverage, because there's varying levels that we're going to do. So what we also had to do was for the limited and the increased scope audits, we had to break those down into 2 groups because the approach will be different if they've had a financial audit by an independent auditor than as opposed to if it was just part of the municipality's audit. I'll explain those a bit further. So the limited scope audit for group 1, that was the group 1.
Volume is very low.
What is that?
I did, it's on the Mac.
So for boards with independent audits, we call them group 1A. The audit plan will include a review of the independent auditor's work. This will include selecting a sample of the work to test, to retest. We're retesting what they tested, not selecting a new sample. It'll also include a review of all the board minutes, cash and investment contracts and fees, unless they're completely invested in PRIT. These are high-risk areas. And then if an additional area of concern is raised by another unit, or if we identify it when we're out there, we'll add it to the scope. Okay, so we'll call it group 1B. These are the boards without the independent audits. This audit plan will include, we'll still be doing the board minutes, cash, and we'll be doing investment values, contracts, and fees. We'll be doing compliance testing in a couple of other high-risk areas. And then again, if there's additional areas of concern is raised, we'll also look into that. So in this one, this is different than the other one because we'll be selecting the sample and we'll be testing the targeted areas, not retesting a small sample of the private auditor's work. And right now, what we're looking at the ones from that chart you had seen earlier, the high ones with the regular comp, retiree calculations, and we're doing cash, obviously. But, okay, so we're moving on to the next group. These are the increased audit scope. So they're not low risk. They're in between high and low risk. So group 2A will be the boards with the independent audits. So again, the audit plan is going to include everything that was outlined in group 1A above, but then we're going to have additional targeted areas to test for compliance. Because these were assessed at an increased risk, that's why we're having a larger scope of the targeted areas to review. So on to the increased scope of the audit, the group 2, and that's the same, I mean, that's without the independent audits. So that would be the same as 1B, and then again, with additional targeted areas, because the assessed risk was higher. So for the boards that are assessed at high risk, we're going to do the full audit scope. This entails all the steps in our audit syllabus, basically the same audit you've had in the past. So those are the audit plans based on where your board landed in the risk level. The audit reports that we'll be writing now for a limited scope group 1A, that's one that has independent auditor. It will be a letter report, including an audit objectives, scope, and methodology section. This section details exactly what we looked at in there, how we did it, what we did for each of the specific targeted areas we looked at. It will also include an explanation of findings and recommendation sections, if it's necessary, and the independent audit report for each year of the audit period. So the limited scope group 1B, this is the one without the independent audit. That report will be a letter report, again, with the objective, scope, and methodology, just so the reader knows exactly what we were looking at when we were in there. An explanation of findings and recommendation section, if it's necessary, and the presentation of the board's annual statements and notes. So it'll look very similar to the report that you're getting now, but they're not the financial statements that are in there are not being bid fine as your board's annual statements. So for instance, a lot of times now, if we go in and see something that needs to be reclassified, in our report, we will reclassify that. But in this report, it looks like we're just going to present them as you submitted them to us on a yearly basis. But the thing is, we haven't completed a report yet under this new approach. But this is how we envision that it's going to look. Okay, so for the increased scope, that's group 2A. It'll be the same as the limited scope. The part B is same as the limited scope, but the audit objectives, scope, and methodology will include a little more because we've done a little more at these in our report process also. So we write the draft report, and then it goes around for review through the PERAC managers. So if it has no findings, the report will be issued after the PERAC management review. If it has findings in it, a draft will be sent to the board for their response. So that's a difference. The reports with no findings, the board will not see a draft copy of. So this is what we hope to do. We've started the process, and so far it's going pretty well. We're to the end of issuing the first report, just not completed yet, but we'll get there. But that is my area here. Did anyone have any questions? No? Okay. So now Scott will come on and go over common audit findings. Where do we go, Cheryl? Here?
All right, and we're back. Looks like my presentation is set up, so let's see if I can advance the slides here. Here we go. All right, like you saw in the graph that Caryn had in her presentation, regular compensation was by far the most common finding. And those of you who have been around for a while, we've been writing up regular comp for various reasons for probably more than a decade. A long time ago, we were getting pretty much every housing authority with their beeper pay. Then the housing authorities gradually got straightened out. There was pension reform, and they changed the regular compensation rules. So after a year or two of settling down with the new rules, most of the cities and towns are fine. The problems we generally see now are related to the school department and their methods of payment. And there's probably a very good reason for this. So up on the screen, what I have here, you probably haven't seen it before. It looks sort of like our regular compensation regulation, but it's a little different. Up at the top, it actually makes a reference to 840 CMR 15.03, which is our reg. Our own reg is not self-referential. We're not sending you into infinite loops, so this is something different. And if you look down the slide a little bit, you can see references to school and teaching. So what this is the teachers' retirement board actually has their own regular compensation regulation. They're a state agency. They get to create their own regs. So this is theirs. And they drill this into the school payroll people's heads on when to take deductions and when not to take it for teachers. So I've highlighted one of the first thing that a school payroll person will mention to you when you come to them to tell them to do something different. They might say, well, the service is not in the contract, because the teacher reg does say it has to be in the contract. And the other part of the teacher's regulation is a list of stuff that is not regular comp, and the most common one being summer pay is not regular comp in the teacher's world. So what will happen is you will go to the school department payroll, start telling them to take deductions on summer school pay, and they'll say, oh, it's not regular comp. Well, it is, just not under the teacher role. So it meets the 840 CMR 15.03 requirements for regular compensation. It's predetermined, guaranteed. It's predictable, so we're taking deductions on it. And similar concept applies to things like before and after school programs, bus monitor, detention monitor. There's a whole list of stuff. Because what the local school payroll person is doing is they're looking at the paraprofessional contract and saying, well, none of these stipends are in the paraprofessional contract. But again, that's the teacher standard, not the standard for the rest of the membership in the school. So when you go there and you're arguing with the school people, try to be a little gentle because they are trying to deal with two different regulations and there are some real differences. So, what? Oh, okay. So, anyway, so besides regular comp, some of the other towers that were a little higher in our chart, besides the miscellaneous one, cash reconciliation, there are various issues, and then the financial board packet that you are hopefully giving to your board members. And I'm going to cover these in the second half of the presentation. So now let's go over some of the things that are not findings. So we don't put them in the report, but we do see them at lots of boards. And so generally you wouldn't see these until we come out and do your audit and we talk about it at the exit conference. But we can go over some of these now and give them a little more publicity. The first one is about affidavits. Affidavits are not mentioned in Chapter 32. They only show up in our regulation, and it's the miscellaneous regulation. 15.01 deals with affidavits. And 15.01 Part 3 says that a board must take a random sample of 5% of the affidavits and audit them. There are a handful of systems doing this, but it is not something that we, as an agency, paid attention to for a long time. What happened is the state auditor's office did an audit of the state retirement board, and after spending a year in their office, this was the one thing they came up with. So now we're mentioning it everywhere we go, but you are all supposed to do a 5% random sample of the affidavits. There's no kind of limit for bigger boards. So I guess if you had 5,000 people, we're thinking, well, it's 250 of them. But there's also no exceptions for if you do use a deathmatch service or if you get all the forms notarized. I mean, I know a lot of people, the ones that get mailed in are notarized, and the people who show up in the office are just showing ID. So there's not too much doubt of who they are, but still that's the regulation, and unless it changes, you are supposed to do it. If you are doing the 5% sample, we would just want you to somehow indicate which affidavits you reviewed. You know, keep a list and mark off which ones you're looking at, just so when we show up for an audit, you can show us, these are the guys I looked at. All right, well, we are pausing for some technical difficulties. The next things I'm going to talk about, and I'm not going to step on Cheryl's toes, she's going to go a little bit into investment-related accounting. But some of the things that we are telling boards they put into the wrong accounts will be the next few slides. So let's go over all the things dealing with the Macros conference, since you're all part of the Macros Association. Those annual dues, they go into 5589 administrative expenses. If you've also got annual dues for something like NCPERS or other organizations, those are also going in 5589. If you signed up for a conference and you're paying the conference fee, that goes into 53820 education and training. And then when you actually go to the conference and you put in for reimbursement for travel, the mileage, hotel, there might be a meal or two, that stuff goes into 5719 travel. We split 5320 and 5719 a while ago because travel was getting kind of large depending on the fees. Account 5315, professional services, is pretty much dead at this point. It was initially set up for actuaries and for the firms who do your audits. Figuring that, well, both of them, you need to be professionally certified to do it. You can't get an actuarial valuation from someone who's not a certified actuary. Probably can't get a qualified audit from someone who's not a CPA. So that's why it was called professional services. It's supposed to imply certification was part of, was necessary for the vendor. We have since split actuarial services and auditing services into their own accounts. So the auditing services go into the account called accounting services. So that's kind of eliminated 5315. If you are using a service, even if someone is certified, it might not be something that requires certification. Like, I'm sure there's plenty of people who get certified in web design or other, Microsoft type stuff, but it isn't required for them as your vendor. So the IT things I would generally put into service contracts. One more thing, we read the minutes at the start of the audit, and more often than you might think, people are missing minutes for a month. Once in a while, the open session, those are generally in a book altogether, but the executive session ones seem to be more likely to be missing. 3 of the 4 of them are in a separate book, but we can't find 1 month. We come across that a lot. So maybe when this is over, just make sure you've got all your minutes together in one place. Because it's really tough to recreate them if you don't have a draft somewhere and it's an executive session from 2016. We look at people's service purchases, both for active members and people who have retired. And when we pull the folders, we're looking at everything in the folders. And with the service, we're looking at if the salary amount used is documented, as well as what interest rates you've been using. And this rule seems to be a little less known than some of the others. If you are buying non-member time, whether it's at your own board or a different one, the amount to be charged once you've got the salary, the contribution rate is the rate that was in effect at the time you were buying. So if the rate was 7% at the time you were buying, you're going to charge the member 7% of the salary, which means you can't have one buyback using multiple contribution rates. Just because the member is 9% now does not mean you're automatically going to charge them 9% for their non-member time. And then the other note down there is the switch from 8% to 9% occurred in the middle of 1996. So you have to do some playing around with the 1996 pay, because part of it is 8% and part of it is 9%. Our form doesn't have 2 lines for 1996, so you'd have to split it yourself, or do the math somewhere else and bring those numbers onto the sheet. All right. So the next part I'm going to talk about is internal controls. That's why we showed a short about embezzlement. Just to remind you of some of the best practices and things to look for. or ways to set up your staff or the way you do things. So the first question, who reconciles the cash? So any board with a where there's a treasurer around, so the existing counties, the city or town, or the authorities, they all have treasurers. The treasurer should be doing the reconciliation. If you wanted to get really technical, if the treasurer is on the board, sometimes we like to have someone else in the treasurer's office do the reconciliation. I mean, that might not be necessary, but it's something to think about. And then the regional systems where there isn't a treasurer, technically the chairperson doubles as a treasurer. What I see auditing the regional systems is some of the chairs do the cash and some don't, but some do it with a staff member. The thing about a regional system is you have 6 or 7 employees. That's enough staff to have different people doing different things. So not all the financial stuff should be done by one person. If someone's doing the accounting, they should not also be producing the warrants and reconciling the cash. It should be a couple different people doing those things. And really, segregating duties is sort of the base lesson of internal controls. And if we go back to the beginning of my presentation, there was a slide about common findings, and cash reconciliation was one of those findings. The issues we do see with cash, one is that the treasurer just isn't doing a reconciliation. Another finding is that the treasurer is doing the reconciliation, but they're either not timely or there's variances on the reconciliation that people just don't know what they are. You get to the bottom and there's a $1,500 difference between the books, and no one knows what it is, and it's been growing slowly month after month. So those are the kind of findings that we write up with the cash reconciliation. More things to think about is the actual production of the checks. I know most of the retirees are direct deposit, so this isn't really referring to them, but there are still some who are getting a check, so you want to know or think about who on the staff can sort of create the checks, who prints them out, and when you print them out, is the signature already on the check? And if the signature is on it, how does it get on that? Is there a password protected copy of the signature? And then how many people know the password? Or do you just print out checks without a signature and then stamp the treasurer's name on them? If you do use a stamp, do you lock up the stamp? How many people have access to that? Could I walk over to someone's desk, pick up a stamp, find a check, and just stamp the treasurer's name on it and type in the word cash on the check and walk out the door? I wouldn't be an auditor long, but I guess I would make it for a large amount if I did that. And besides who can create the checks, where are the checks being kept? Generally, they're in the treasurer's office, which is good. It means that the retirement board staff can't just take one off the top and use it. And again, if the treasurer is on the board, maybe you want to think about putting it in someone else's office, someone who does not have signatory authority. Maybe the ex officio could lock them up somewhere in their office. And a check log, what we are thinking of when we talk about a check log is either a list of checks or something that at least has, this month we use check numbers X through Y. So the next month you better start with Y plus 1. If you're starting with Y plus 2, then, well, what happened to the missing checks? So it's just a way to make sure that there are no missing checks. And then when you receive money, who's taking the trip to the bank? If something comes in the mail, what's the process you use for that? If someone walks into the office to purchase time and hands you a check, How do you handle that? And again, the person depositing the check should not be the same person who does a bunch of other cash-related things. Who receives the bank statements. They should be sent to the treasurer. If you get them, do you give them to the treasurer unopened? And kind of related to that, I know a lot of administrators have electronic access to the accounts where they can open up and see them. So if you're on a board, you just want to think about how that is controlled. What are the safeguards to what your administrator can or can't do if they're looking at the bank accounts electronically. The cash reconciliations themselves should be shared with the board. Every month you should be giving the board a financial packet, and it would include the cash reconciliation. As part of that, you should include the bank statements as well. And one thing we see at a lot of boards when we look at a recon, it's just a plain sheet of paper and we don't know who did it. You know, did the board staff do this in Excel or what is this? So if the reconciliations are either signed or initialed by the preparer, and dates help as well, that tells us whether they're being done timely or not. And the final thing on the reconciliation is when the treasurer is taking the bank statement amount, what number exactly are they reconciling to? The treasurer's got their own books. Are they reconciling to just their own number? Or do they get an amount from you to reconcile to? Either from a trial balance, general ledger, or you just tell them over the phone. Treasurer will have trouble in January or February reconciling to your numbers because you haven't done the annual statement yet, so your books are still pretty much on the year before. I know there are places who do enter the cash transactions only and then send that amount off to the treasurer. You can kind of do that real time, but the first few months before the annual statement's done, the treasurer might just be looking at their own numbers only. And then what will happen is if you get the reconciliation and their ending balance doesn't quite match the ending balance you finally got to 3 months later, you might have to do some research, try to figure out why there's a variance. If you're really stumped, you know, ask the treasurer about it. Maybe you and the treasurer have to just sit down together and go through, you know, what was in, what was out, and here's the difference. Positive pay is an anti-fraud procedure where the treasurer or someone will send a file to the bank with information about all the checks on it. And so if someone forged a check or altered one, it in theory will not get cashed and you would get notified. So I think banks do charge extra for positive pay. I don't know how much it costs, but there are quite a few places who do use it. And then the final cash-related thing to think about is for wire transfers, who actually moves the money. I mentioned earlier, the administrator might have electronic access to your deposit account and a payroll account. Maybe you let them move the money, but do they do that move after a board meeting where you've voted on a transfer or at least seen it on a warrant? Maybe not a warrant, but like maybe a cash flow forecast, especially if you keep cash close to zero, so you're always drawing down your assets. You would want some sort of method of looking out 3 to 4 months to know where you're going to get your next funds to pay the retiree payrolls and the vendors. And so as briefly mentioned, every month the board should be getting certain financial information just so they can make sure things are being done timely and correctly. And we do have findings on this, especially if you're not giving them anything. And I'm not talking about custodial statements. I'm also not talking about manager statements, which may also be known as manger statements if you leave out the second A. But they should be getting the cash reconciliation with the bank statement. The monthly accounting, you can either throw into a packet, or I have lots of administrators ask me if it's okay to just CC the board members when they send the cash books into PERAC. I don't see any reason not to do that. So it might not be in the packet because they've already gotten the accounting 2 to 3 weeks earlier as you do it. If you are doing that, I would just make some sort of note in the minutes that the board members have seen the accounting, because we're not going to know that you send them an email in the middle of a month, but we do like to know that they have seen it. The minutes should also mention what exactly they see in their packet, so it would be the cash recon. And it's also nice if you tell us which month they're looking at. Instead of just all 12 months, you say board looked at cash recon and accounting. We know they don't see accounting every single month. When you do the annual statements, there'll be a month or two where there's nothing. So just put the month or months that they're looking at. So besides the accounting, the last 2 bullets there, the board should have a budget, and once in a while, we say at least quarterly, look at how the spending is going versus the budgeted spending. And then that cash flow forecast where you're trying to project what will and will not need to be sold to raise funds as the year goes on. I think that's it for me. Are there any questions? No. No, if you do have questions, you can type them in. And I think next is going to be Cheryl talking about the accounting, which you're going to CC your board members on when you send it to us.
Are we good?
I shouldn't have hit mute.
Are we on now?
Ask if people can hear you.
Can people hear me? This is Cheryl. If you can just type in yes or no.
No, don't type in no.
Oh, that's right. Type in yes. It's not on mute. No. Oh. Can anybody hear us? Oh.
Should we press off again?
Hello, we're back. For that first time with the phone. Okay. So this is Cheryl Johnson. Today I'm going to be talking about some of the cash book submissions, a few of the accounts, general ledger, journal entries. Let me just pop this one down now. Several memos have been circulated over the years, and I've identified 3 as a quick reference: Memo 24 of 14, 15 of 15, and 16 of 19. Also, PERAC has created a dedicated email for cash book submissions, and we encourage all boards to use that. The email address is
on the screen. It's per.per.state.ma.us. Regulations 840 CMR 4.0 establishes the method of accounting for boards as described in MGL Chapter 7, Section 5, and MGL Chapter 32, Section 21. Boards must submit their cash books within 4 weeks of the close of each month. These submissions should include, copying over Scott's last comments, the year-to-date trial balance, monthly cash receipts, disbursements, adjusting journal entries, as well as a monthly general ledger. Where applicable, the board should also send or have sent a custodial statement detailing cash, short-term investments, income investments, equities, and pooled funds. Accounting activity details should include purchases, sales, income, dividends, fund expenses, and ownership interest of the retirement system and any commingled funds, including but not limited to separate accounts, bank pooled funds, mutual funds, group trusts, and limited partnerships. For board with active members, particularly the alternative investments, some of the quarterly reports are not finalized until well after the board's 4-week submission deadline. In these instances, many boards are using a quarter lag in reporting market value, but adjusting for capital contributions and distributions. This is a common practice within the industry, and we see that in valuations used by both consultants and consumers. This process would help the cash books being submitted on time by the boards. As an aside, it's very important to have annual statements submitted on time and accurately. We have seen variations between fees being reported in the ledger accounts and different on the Schedules 5 and 7 in the annual statement. In one recent instance, the Schedule 5 was missing several columns of information, including fees. The aforementioned information is necessary for PERAC to determine the rate of return on investments as annually published for each retirement system. Using the proper ledger accounts when recording your entries is important for record keeping. If you have a question on the classification of an item, I would encourage you to reach out to your analyst for input to avoid corrections in the future. Another helpful option with the board record keeping, which some boards already practice, is the use of sub-accounts. If you're currently not using them, I encourage you to reach out to your investment analyst if you would like more information on this process. Regarding the recording of investment-related fees, 5307, investment consulting fees, only your investment consultant fees should be reflected in this ledger account. Any other services currently being included in this ledger account will need to be reclassified. For account number 4304, management fees, these need to be recorded for every investment. Funds that are reporting net still must have a management fee recorded separately in their ledger. Not all fund statements do supply the fees on the monthly or quarterly statements. And we know that nobody works for free. So that figure should be provided to you by the investment manager. Other sources we've found for fees have been submitted by the manager on the annual vendor disclosures, which you are provided as well, or possibly your accountant would be able to help you access that information. In the rare instance that you own a legacy investment and management fees are no longer being collected, a fee of $0 should be noted on the schedules. A fee for every investment should be noted on either Schedules 5 and 7. The custodial fees are more standard. Whether the custodian sends a bill or charges the account directly, those fees should be recorded. These 3 ledger accounts I've discussed have an impact on the gross performance of the fund and should be accurately reflected in the account for the rate of return for the portfolio mentioned earlier. 3 new ledger accounts related to investment-related expenses were introduced in 2018. These are expenses related to fund investments but are not accounted for as fees. 4701 is regarding carried interest. Carried interest is the sharing of profits between the limited partner and the general partner once an agreed-upon performance hurdle has been met. Details should be found on your quarterly manager statements. To account for this sharing of the profits, the carried interest would be debited to the carried interest, and the investment account would be credited by that amount. In some instances, if a fund has underperformed, the carried interest would be given back to the investor. This is called a clawback. and the reverse entry would be made, debiting the carried interest account and crediting the investment account. The true-ups are meant to equalize an investment for all investors in that fund. Again, this could be an expense or income depending on when an investor buys into the fund and whether that investment has performed well or poorly. In a positive performance environment, a new investor would have to pay an earlier investor the amounts calculated by the manager to put everyone on a level playing field. This would be accounted for by debiting 4702 and crediting the investment account. If you're an initial investor, you would be receiving the true-up income. It would generally come in the form of cash, so you would treat this as investment income, but that might vary. 4703 is sort of a miscellaneous bucket for other expenses, administrative, portfolio monitoring, office expenses. And that, if it's not 4701 or 4702 on your quarterly statements, 4703 would be the bucket to use. Always reach out to us. These accounts all close out of the year to the investment income account 4802. I do have, from previous training sessions, just copies of how these 4701, 02, and 03 accounts would translate to your schedules. I didn't use them all. I'm just going to give you one example of each investment. This Schedule 7 would have, on the far right, the 4701, 02, 03 are carved out of the fees, but we still want them to be reflected. If you see on vendor GHI, where there is not a fee there, if you didn't pay a fee, we would like to see a 0 or just something. As long as it's included, though, at least you're reflecting all your manager accounts. This is an example of what was going on in the Schedule 7, and these would also be going in your, I think they'd be going on your Schedule 5. Yes. Management fees would be going in 5304. Professional fees or other expenses would be going in that bucket 4703, and the carried interest would be going into 4701. And this would be a traditional carried interest where you would be charging against your investment and adding it into carried interest. This one's harder to see, but this is a true-up that the manager sent out. And the initial investment, we made it larger down here. The initial investment was by the board. They only received an investment worth $9,601 and change because they had an equalization charge against their $10 million of $388,000 plus that were going to be going to earlier fund investors to equal out their investment. The other thing I want to remind people about are revisions to the cash books. Revisions have been addressed in Memo 24 and 15. Errors happen. We're all human. But according to generally accepted accounting practices, GAAP for short, these errors, once recognized, should be recorded in the period the error was found. A couple issues to point out with backdating activity or market value updates is, firstly, going back and changing information previously reported undermines the reliability of the accounting records and could lead to the contention that the system is deliberately misstating its financial results to mislead or otherwise obscure the operations of the system. Secondly, it can skew the books. If backdating were to occur, revised cash books would need to be resubmitted beginning from the date of the revision to current, as the books would not likely balance anymore. The memos are quite clear that backdating is not an approved accounting method. The rule is to report all errors and changes in the current accounting period. There's a lot of data going into the cash book preparation, and it is important the board members are aware of everything. So just reiterating what Scott had already covered. Review with cash books at the board meetings or sent to the board in advance of the meetings is strongly encouraged and a great practice of keeping up with the board activity. For boards that were delayed in submitting their cash books, PERAC has instituted a new protocol. 60 days after the end of the month, 4 weeks after the cash books were due, PERAC will be sending an initial reminder email to the board administrator, and if applicable, copying the staff person who is responsible for preparing the books. If no books had been received after 2 weeks of that initial reminder, a second reminder will be going to the chairperson for the board as well as a copy to the administrator. Lastly, if the books are still not received, PERAC may begin the suspension process. Hope this will not be the case, but have a process in place if the issue does arrive. And while I have your attention, I'm just going to jump over with my compliance hat on and just have a few housekeeping items related to procurement submissions through Prosper, as this reflects the investments in your cash book. It is important to have a correct investment fund selected when a procurement is being submitted. If you do not see your fund in Prosper, contact PERAC, generally myself or Rose Morrison, and we will add it to the system. You might see the manager already in the system, but are planning to invest in a different fund, be it small cap versus large cap, or Fund 5 versus Fund 4. Ask for a copy of the contact sheet for new managers or an accurate name for the fund if the manager is already in Prosper. It is important to get the investment name correct, as other boards might ultimately be investing in the same fund. Also crucial is to let us know what share class you're investing in. We recently had 3 boards investing in a fund with the same name but different share classes. It's important that PERAC knows that in advance as they're requesting the annual vendor disclosures, and there's a possibility of different fees at each fund level or each share class level, and we'll be possibly looking for a different data in the disclosures for the various share classes. If the board is investing as a separate account rather than a fund, please state that as well, because it's recorded in the Prosper system differently. When submitting the evaluations for the search, be it a consultant or board-driven, please send the full evaluation rather than just the finalists. PERAC looked at how many people responded to the search and how each respondent was ranked. This is one way to review the process was fair and approved for acknowledgement. Renewals. If a board has done a search and determines to retain an existing manager, along with the standard procurement submissions, PERAC requires that that manager be current with their annual vendor disclosure filings. You should be able to see if this is the case on your board portal. That concludes my presentation. Does anyone have any questions?
Any of the presentations given today? We don't see any questions coming in, so I guess that will conclude our webinar here. Thank you for your participation. Have a great day.